Welcome back to The Breakdown, everybody. I'm your host, David Canellis, as always. Today, we're going to be talking about tokens and equity because of all this stuff with Venice, the permissionless, privacy-focused AI terminal. Is been under fire because it raised $65 million and valuing the company behind the VVV token at $1 billion. Well, at the same time, there's this VVV token floating around, and the market has kind of rejected the token post-equity raise, and it's raised some questions over why do we need this token at all, why can't equity and tokens be the same thing, and also a bunch of growth numbers surrounding Venice that I thought might warrant a closer look. So without further ado, this is the topic for today. Let's get to it. This is The Breakdown.
Nothing said on The Breakdown is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are opinions, not financial advice. Hosts and guests may hold positions in the company's funds or projects discussed.
Okay, so we're going to keep this quite focused because there's been quite a lot spoken about this already. And if you want a decent conversation about all of this, it's worth tuning into the Empire podcast, the most recent episode with Blockworks co-founder Jason and Rob Haddock, partner at Dragonfly Capital, who has led this raise. And they try to go into the nitty-gritty over some of the decisions made and really the state of play of the situation of tokens and equity. But to give you a broad overview, if you're not familiar with Venice, I mean, I have it up on my screen here. It's essentially a terminal. It's essentially an AI router for you. So you don't have to buy the VVV token to use the platform. You have a certain number of free credits, the same as ChatGPT and so on. But what you can do is purchase VVV and stake it. What that allows you to do is essentially lock in the price of your compute. So if you purchased 1% of the VVV supply right now, staked it, you will receive in perpetuity 1% of the total Venice compute. So it's a way of hedging your future compute costs by getting in early. And there's some other things as well that you get access to. You get access to a pro account and all that kind of thing. So there's perks and everything like that as well. But that is the primary utility of VVV. It's worth jumping onto the platform and playing around and seeing how it works. Now, the company itself, it's not like it's a fully decentralized company. It's a centralized company, and it's also a centralized service. It's not like Venice runs on a blockchain or anything like that. It's just purely the token that is really the intersection of Venice and crypto, and it does interact with the near blockchain as well. But it's not like the whole protocol is a decentralized protocol that's launched on blockchain rails or anything like that. So it's important to get that out of the way. VVV is not a governance token for a DAO or anything like that. It's purely a utility token as a way to access compute. And if the cost of compute is destined to go up, as many people think it will, then the primary utility for you as a user is to essentially get a discount on future compute costs if you outlay it right now. That's kind of the idea. The token itself launched over a year ago in January 2025 via an airdrop to early users. But you can see on my screen that it was an immediate dumping, and there was a lot of controversy at the time for Venice insiders and market makers that were connected to the initial launch that initially sold a lot of their tokens and kind of made a killing on the way down. Since then, we've had a long period of price discovery. And up until the point last week that we have this reveal from founder Eric Voorhees, long-time Bitcoin entrepreneur from Shapeshift. He has come out with this raise on July the 1st. So here on my screen, you can see that on July 1st, the market essentially peaked. There was a little bit of a rally upwards following the equity raise. And then once the market kind of figured out that token holders were not going to immediately benefit, or there was no real benefit for token holders from the equity raise, and it became clear that, there is this dichotomy between venture capital investors, equity, the company itself, and then token holders who are kind of left holding the bag in the meantime. We've seen the market reject VVV somewhat. So it peaked at 2082 2 days after the raise, and since then it has dropped basically almost 50% from 2082 all the way down to a current price of around 1158. So almost a 50% drop on the back of news that should be good news for people who are interested in gaining financial exposure to the growth of the Venice platform. So, what is the raise? I mean, why raise at all? Why sell equity in the company instead of just issuing the token? And well, Eric Voorhees goes into some detail in this thread here that I have up on my screen. The general idea is that, as he said here, as of Q1, Venice achieved profitability. So why raise it all? For scale. We are making Venice a mass market consumer app, an open and unrestricted AI platform for at least a few hundred million people, and several billion AI agents. Doing so requires capital. Some of the capital will be used to vertically integrate compute. We've begun a data center build out and will be the first time Venice has owned its own compute. This ensures capacity in the coming resource squeeze and increases gross margins, making larger VVV burns feasible. The rest of the capital will be used to grow customers, enter new markets, acquire additive businesses, and hire killer talent. So they're building a data center, and effectively they need money to do that. And they were faced with two choices: either dilute current token holders by selling some of its tokens, or maybe even creating new tokens and sell that to venture capital in order to get the cash to do the data center build out. But rather than do that, they've opted to instead sell equity in the underlying company of the Venice platform and use that cash to build the data center instead. That is the reasoning. And on some level, I do see the logic there, but you are also effectively diluting token holders by selling the equity, because you have now created two things that are valuable to investors rather than one. Now, there is an argument against that the VVV token itself should not be considered as equity in the protocol, because Venice is not a protocol. It should also not be considered equity in the business either. What the VVV token is strictly a voucher for compute. And if token holders want to speculate on compute, on tokenized compute effectively, then that is separate from investing in Venice, the company. And, if you've been in the token market for quite some time, you know how wishy-washy this whole thing can be. Now, this whole debate it triggered Dragonfly partners into action because, of course, they led the round. I'm going to play a clip from Haseeb Qureshi, partner at Dragonfly Capital, who has some more context here about how they view the split between Venice equity and the VVV token. I'm going to play it here now.
Now, we led a $65 million investment into Venice at a $1 billion company valuation, in which we bought equity, as well as exposure to VVV, which is Venice's primary token. Now, this round struck up a conversation about tokens versus equity, and whether it's wise for a company to have both equity holders and token holders. The argument goes that this is messy, because the incentives between the equity holders and the token holders will eventually diverge. Now, I'm no stranger to this conversation. I have been a very vocal critic myself of the protocols that have gone down this road. And I've said this in the past, and I will say it again. When a token represents the ownership of an underlying network, it should have one clear ownership structure. So when Uniswap very famously had a divergence between its token holders and its labs entity, they did this fundraise where they sold tokens, and then eventually they raised money for their labs. When the labs were supposed to be subservient to the protocol, I was very publicly critical of that. And I've reflected that exact same viewpoint to many of our protocols who've contemplated going down the same road. Now, here's what's important to understand about Venice. Venice is nothing like Uniswap. Venice is not a DAO. Venice is not a protocol. Venice is not an on-chain product. VVV is not a governance token. It's not an ownership token. It has never been that. And this has been very extensively explained and documented by the team. Okay, so what is VVV then? VVV is a compute capital asset. Okay, what does that mean? That means by holding and staking VVV, you get access to compute perpetually on Venice. You get other stuff too. So there's staking yield, there's access to Venice Pro, but the main thing is that you're effectively pre-buying compute on the platform. So you can sort of view this as analogous to pre-buying TSMC capacity, or pre-buying data center capacity, or GPUs, or whatever. It's a fulfillment guarantee of the core product of Venice. And if you know anything about compute, you know that this is really valuable. And it's becoming only more valuable over time. It's not just valuable because compute is valuable, But it's even more valuable because Venice is growing like crazy. And therefore, the market is valuing a share of its product more and more highly as the company grows. Okay, so I think this is incredibly interesting. Now, Venice is buying back and burning VVV using its own revenue from subscriptions. This is going to make VVV net deflationary. Now, why would they do that? Are they stupid? Are they running a charity? Is it because VVV is secretly equity? Wink, wink. No, okay? No, none of the above. VVV is a commitment that the team made to allow people to use inference for free in perpetuity. That means VVV is a liability of the company. So there are obvious reasons why they'd want to buy it back. Retiring VVV frees up their GPU capacity that they can then sell for cash instead of giving it to a VVV holder. It basically, they can recoup the cost if they're selling that compute to an actual customer, paying in cash, as opposed to a VVV holder. So, okay, that might make sense. We wanted exposure to VVV. We, Dragonfly, built our position through the direct exposure that we structured, as well as the enormous amount of VVV that the company holds on the balance sheet. We are aligned with VVV holders. Now, we didn't do this because we're confused about VVV. We did this because we understand exactly what VVV is and why we believe it will accrue value over time. If we believed that the token was worthless and that the equity was the true value of the business, then we wouldn't be buying exposure to VVV. We just buy equity, but we didn't do that. In fact, we demanded it during the fundraising process, and we had to make concessions in order to get it.
Okay, so I'm just going to leave it there. So, I mean, if you really look into the details of what he is saying, there is two separate things that are valuable here. There is the value accrual promises from Venice that is going to buy back the tokens and all of that sort of stuff. And then there is the equity in the company. And these are two very separate things. Until this moment, there has been not so much clarity over that because of just years and years and years of debt from the crypto space in considering tokens as pseudo equity, because that's all that regular people have had access to. If you can only buy the Solana token, you can't invest in Solana Labs, then of course you're going to consider Solana as Sol as a proxy of for growth in that protocol. And so this has really kind of reshaped even just subconsciously how the crypto market views tokens, and this whole debate is a product of that. And it's unfortunate that Venice has had to go through this when in itself, I mean, and if you go back and watch the Empire episode, you're going to see that a lot of this comes down to is that there's no regulatory clarity over how to actually structure a token as equity. So it would be nice if Venice equity and the VVV token were exactly the same thing. But there's no real way through that right now. And it's very messy because the VVV token has already launched. So even if there was, say, clarity action tomorrow, it's not like it would be very difficult. It would be somewhat of a headache to Venice go and retroactively package VVV as a new regulated tokenized security, because it's already done the fundraise and it's already launched the token. It's already generated revenue from selling the token and so on. So it's quite difficult to undo that after the fact. But it's also, I mean, the reality of the situation is that Venice right now is promising that it is going to use the money that it has raised, the $65 million Series A, the money it has raised, it is going to go and build a data center. It's going to go and scale and expand. And eventually those efforts will filter down into the VVV token via the fact that it's going to be able to have more compute, it's going to be able to service more users, and if more users subscribe to the platform, then it will eventually buy back the VVV token, and all those users have to buy VVV and stake it in order to access the platform as well. So all of this is going to be accretive to the VVV asset, but it's all this trickle down stuff that is so separate from the value of the equity. It's that the company insiders have benefited from the new unicorn valuation, but it's not like that flows directly to token holders. It might in a year, maybe 2 years, maybe 3 years. Maybe that's when all of this cool stuff that's making a lot of these founders and insiders quite wealthy on paper, this is the frustration that many people are feeling. But as we can see, the token is down 40 or 50% on the back of that good news for people who are exposed to the equity. And it's this, I mean, you can debate the details of it all you like. And a lot of the objections might be legitimate. A lot of the defenses are also legitimate. You know, you're kind of damned if you do and you're damned if you don't in terms of this capital raising structure because of the regulatory environment that we are in, still in, with clarity not looking less likely to pass by the day. But we know that frustration is not all the time completely logical. It is the emotional response that is most difficult. What I want to pick apart, and I'm not trying to be too nitpicking because I mean, Eric Voorhees gets it better than most, and I know that a lot of stuff happened with the Shapeshift DAO, and I mean, if you look at the Shapeshift token, it's also basically down only, and obviously he's trying to right some of those wrongs, and Eric Voorhees gets it better than most over why this whole thing exists, what the innovations of tokens can be to capital formation and internet capital markets and everything like that. I get all that. What Haseeb is doing, though, is he is front-loading a lot of this conversation. I didn't play it in the beginning, but let's now play the start of this video just to see, I mean, the whole thing about this equity raise is it is an implicit promise that Venice is going to grow. The platform is going to grow. It's going to be able to service more users, which eventually should flow down into the VVV asset. Let's just see how Haseeb frames all this growth.
Data. They have 3.5 million active users. They've got 12 million monthly visitors, and they serve over 2 million API calls a day. Okay, so this is a big business. It's got a 70 million revenue run rate, and it's growing something like 15% month over month. So it's growing very fast. Now, we led a 65.
Those numbers are crazy. I mean, I just got to say, what did he say? He said 3.5 million active users. They've got 12 million monthly visitors, and they serve over 2.5 million API calls per day or something. I mean, that's a little bit crazy. I just want to find out if that's true. Okay, so let's have a look. Okay, so I mean, all we can really do in terms of its monthly visitors is to really have a look at something like SimilarWeb. And yeah, in May, it had 12 million visitors to Venice.ai. So 12 million visitors to Venice.ai, which is essentially like, I guess you can think of it as like DuckDuckGo for ChatGPT or Grok or whatever. Here you can see the free calls that you can make through the Venice.ai platform are to Kimi, Grok, and to Claude. Okay, so let's just have a look at Venice.ai, because Venice.ai is getting 12 million visitors per month. If I just try and prompt this without a thing, I effectively just get requests to update my account. But here in Chat Classic, I can prompt it. So this DuckDuckGo style wrapper for Venice is receiving 12 million visitors per month, but this is not being monetized. So it's kind of up to you how you would frame, the utility of those 12 million visitors. It's not like those users are being monetized. Now, notice that Haseeb doesn't say paying customers or anything like that. So how do we figure out how many users Venice has? I mean, we could look at the Venice token itself. So VVV token currently has 138,500 holders on base. And that doesn't count, obviously, people who are holding the token on crypto exchanges and so on. That's just the number of addresses that have the VVV token. And okay, so there's that. The other thing that we can check, I mean, so of course, you don't have to, it's not like only users of the Venice platform are holding VVV. So we know 138,000 addresses are holding Venice. Now, there is also a second token, DM, that you receive in return for staking your Venice. And DM is actually the tokenized compute vouchers, I guess is a way of looking at it. On Basescan, there is about 4,600 holders of the DM token. So that essentially points to how many users how many paying users there are on Venice. And perhaps I'm screwing up some of these details. And if you're more well versed in the tokenomics and the dynamics between these two tokens, then please reach out to me and correct me. But what I'm looking at is about 4,600 holders of DM, which means that is the people who are holding tokenized compute and actively using the platform every day, at least the upper limit, you would say. So for those 12 million active visitors or 12 million monthly visitors via SimilarWeb to Venice.ai, about 4,600 or so are taking full advantage of their tokenized compute credits. And there are some dashboards as well. I'm going to bring up a couple of dashboards as well that show this, that show the dynamic of the supply, so we can get a real sense of what the growth actually is for Venice right now. We have this Venice dashboard from June up here by Max DeSale. Hopefully I'm pronouncing that correctly. I'm sure I'm butchering it. But this shows you the growth in the amount of VVV that has been staked. And of course, staked VVV is also not directly comparable to pure users, because people might just be speculating on the price of the VVV asset and then staking it in return for yield. I think it's about 8% yield that Venice is paying right now just for that. But we can see that about 28.5%, nearly 29% of the total VVV supply is currently staked. There is the corresponding addresses to that. The number of unique VVV stakers is about 14,400 unique staking addresses. And of course, those don't have to be all individual users. That can also be one user, say, controlling 1,000 addresses, perhaps in promise of future airdrops or something like that may or may not happen. We know that these numbers can be gamed, but let's just treat it at face value that perhaps we do have about 14,500 people staking VVV, while we also have 4,500 holders of DM, which is essentially the tokenized compute. So for all those millions of monthly visitors, a very tiny fraction are actively using the tokens for what they are for. What does that tell me? I mean, we can also see the historic staked VVV supply. And having a look at the official, Venice has an official token dashboard, and these numbers are combining both staked and locked tokens. But effectively, I would say they are quite similar. We can see that there has not been significant growth in the amount of VVV staked for at least 2 months. We saw a big drive up throughout 2025 as the token launched, as the platform began to gain notoriety and steam. And it has effectively topped out as of April. And since then, we've actually seen a slow decline in the amount of VVV that has been staked. So, okay, like on one, what Hasib is painting is this picture of immense growth for the Venice platform. And we did see that last year. And the idea is that we can go out and Venice can go out and raise a bunch of money and scale this more and attract more users over time. And that will flow down into VVV. But right now, we're not really seeing that growth sustain itself. Perhaps we will. Perhaps anything is possible. But what Hasib is painting is this picture of a rapidly growing Venice platform, to the minute. But that's actually not quite the case. There's been about 2 months of sideways action, and now a slow decline in the amount of people who are staking VVV in order to either receive yield or the DM compute tokens. And so one thing I will say is that there does appear to be some positive correlation between the price of VVV and the amount of people actively using the platform with its paid features. Let's say that. So that might tell you something, I suppose, that that it is possible that holding the VVV token does give you some exposure to the growth of the platform. But that's also not what is being communicated. What is being communicated is that buying the VVV token is a way to hedge your future compute costs to make them cheaper. But that is what is happening. What seems to be happening is that the value of the VVV token seems to be correlated to the amount of users who are staking VVV, which it makes some sense. But there is some disconnect here with what would be the best case scenario, what is the neatest way through all of this for equity holders, for token holders, and for the platform itself, and the reality of just the speculative nature of crypto markets. So what I worry that this is just going to become frustration that will build over time, and unfortunately for Venice itself, this will be a recurring theme that when the token price goes down, people will be watching. Is the platform growing? How are these things connected? And another thing that is also just being hammed up a lot is the amount of VVV that Venice is buying back and burning, and that is going to be so value generating for token holders. But as we can see on my screen, the amount of VVV that is being bought back and burned is decreasing effectively every month. We saw a lot of VVV burned in December, 57,000 tokens. In January, it was 45,000. February, nearly 38,000. In March, 22,000 or just under. In April, 16,500. In May, only 11,400 Venice was burned. And in June, it was less than 10,000. It was 9,000 VVV that was burned. So I'm not too sure that all of this counteracts the impact on sending a clear message to venture capital investors out there that if you want exposure to the thing that is growing the most, and that appears to be the company itself in terms of valuation, then you should probably hold the equity. That is a separate thing from whether or not the compute vouchers in the form of VVV are going to increase in value over time. Right now, we are seeing that my read on it is that most of the value of the VVV token is speculation. It is not actually the cost of the actual compute. And so this is all going to come to a head, at least over the next year or two, while the Venice build out happens and while it gets its own compute and its own data center and it can scale and build more users. We're going to have a big disconnect where token holders are waiting for that value to accrue while the company itself seems to be doing fantastic. And all power to them. Founders should be able to do fantastic. Companies should be able to grow and scale, and people should be able to, benefit from the fruits of their efforts. But token holders eventually will have to get something for it, or else they're just going to leave, and we're going to see value and price drain from VVV over time because it's not exactly mapping one-to-one, and there's going to be this big delay. The billion-dollar question is then how patient can token holders be with waiting for that flywheel to start? And, as fickle as crypto markets can be, I worry that this is going to be something that will hang over Venice for quite some time. I'm very happy to be wrong. That I've ranted about AI, privacy, and so on, and Venice is obviously presenting a solution to that. And it is just unfortunate that we can't have true and complete innovation at the token level in terms of really giving the widest net of people exposure to what should be a very powerful platform and a very important platform for us all moving forward. But let's just, as always, the devil is in the details, and let's just see if some of those things can be ironed out over the next few years. I am very closely watching the price of VVV over the coming months. What is going to be telling is that as Venice gives updates to these build outs, and as we see, perhaps growth return to the paying customers and everything like that for VVV, as we see that growth return, I would be very interested to see if the next announcement over something to do with the health of the company or the status of these build outs, whether that actually moves token prices. If it doesn't, then I would have to say that a lot of the investing confidence has been drained from VVV, at least for the time being, and we might need to see, new capital bases, new investor bases come into VVV in order to make any of this make sense once again. But very interesting times indeed. This is about all I'm looking at for today. Please reach out to me. Let me know if I've missed anything in terms of, in terms of how to judge these two separate but somewhat intertwined systems of the company itself and its equity and the VVV token and also DM, because this has been something that is missing from the AI boom in general, is actual tokenized compute. And VVV is not exactly that, but it's like a promise. It's like a coupon for compute. It's not essentially tokenized compute, but it is. I guess we're almost there. We call them tokens, but why aren't they actual tokens that trade on a chain? We kind of have that right now with VVV, but I would love to see a little bit more pure play version of that. Perhaps this is a very early step in that direction. We will see that we will see that finally. But that's enough out of me. Let me know what you think. And as always, look after yourselves. We'll see you next time.